Hi, I'm Tony Nunn and I'm National Sales Director for Charles Darby Mortgage Bureau. Welcome to Module 3 of this series of protection planning modules. And if you've already watched Module 1 and 2, you will understand the implications of not having any protection and have a decent grasp of what the state doesn't provide. This module plans to cover what solutions generically exist and where they may be appropriate in a mortgage world. The objective being that by the end of the module, you'll be able to comprehensively understand what may be required and why. Accordingly, this module will talk about protection in its generic state as products vary from life office to life office, as do the terms and conditions applicable to them which may need to be considered so that they may best suit your client. So let's have a look at generically what's on offer from the world of protection. Generically, these are the most common policy types associated with mortgage planning. Life insurance, KIC or critical illness cover, sometimes referred to as serious illness cover, and terminal illness policies. The clue is in the title. So let's have a look at them each individually. So life insurance. This is a policy which does exactly what it says on the tin. In the event of the policyholder's untimely demise, pays out a sum assured amounting to whatever the cover agreed under the policy was, and in the way described by the policy, i.e., a lump sum or a regular increment. In a mortgage world, a lump sum may be more appropriate as it enables the recipient of the funds, generally a spouse or partner, the ability to redeem the debt in whole, as the policy tends to be written for the amount of the mortgage that's been advanced. There are policies which pay out a regular increment, and they do have a place in financial planning, but tend to be more in the family protection arena, and we'll have a look at those shortly. As alluded to earlier, products can vary considerably, but again in a more generic state, life assurance in a mortgage world tends to come down to two policy types: decreasing term and level term. A version of these two policy types tends to apply to a capital interest repayment mortgage and an interest-only mortgage respectively. So let's take a closer look at the finer detail with regard to decreasing term. Technically, decreasing term is a policy whereby the life insurance element of the policy is reducing from its inception to the end of the policy period, i.e., as each month goes by, so the life cover is reducing until eventually cover is exhausted and the policy terminates. This is illustrated in the graph on the right at the top. Level term insurance is exactly the opposite, and the life insurance element is constant throughout the policy period until the policy terminates. Again, this is illustrated on the right and is the bottom graph. Decreasing term insurance is further defined in the event of it being used as a suitable policy for a capital and interest repayment mortgage, and can sometimes be referred to as a mortgage protection plan or mortgage life insurance because it is specific in its purpose. Specific because it aims to cover the amount of mortgage debt for the term of the mortgage, and so is designed to attempt to decrease at the same rate as the mortgage is being repaid. So in an ideal world, at any point in time, should the policy need to be claimed upon due to your client's untimely demise, the debt may be redeemed in full. The word to the wise is that whilst the decreasing element of decreasing term cover is designed to simulate the repayment of the debt, because of the unknown factor of interest rates throughout the lifetime of the mortgage, generally these policies work to an interest rate ceiling. Accordingly, they only promise to redeem the mortgage debt in full should interest rates not escalate beyond the policy's design ceiling. Suffice to say that the thing to note when comparing policies is this said rate. For example, on screen now is an extract from an L&G policy booklet detailing exactly this. And in my experience, rates can vary, and I've seen rates anywhere between 8 and 10% as a ceiling. Decreasing term is also available as a standalone product for general financial planning and operates in the same way, but generally the interest rate ceiling is slightly lower. One such use could be for inheritance tax purposes when a gift is made prior to 7 years being elapsed. But this is not something for you to concern yourself with, but instead would be a referral to a wealth advisor. However, having said that, family protection could well be within your remit, and it may be that your clients, whilst wanting you to initially protect their mortgage, may have young children which may represent an area of concern for them. In this instance, a family income benefit plan may be appropriate. This too is classified as a decreasing term type policy for the following reasons. Rather than a lump sum payment, cover is generally payable as a monthly increment when in claim. Therefore, it may be that the aim of the policy is to protect against loss of income into the family unit for a period of time, perhaps whilst the child becomes non-dependent, or to protect against the cost to the family unit, perhaps childcare while the remaining spouse or partner maintain their career. It could be paid out as a lump sum, but is at the life office's discretion, and an actuary will make the decision as to exactly how much will be paid. It will not be as simple as the income left to pay multiplied by how many months left to expiry. This qualifies as a decreasing term plan because the total payout decreases over time in line with the remaining term. Consequently, it tends to be cheaper than an equivalent single lump sum life insurance policy, which runs for the same period. Cover is only for as long as the policy runs, and once the term ends, the cover and any income payments received from it will cease. For example, if your client has a 20-year policy and dies 5 years into it, then the policy will pay out a regular income for the remaining 15 years to their nominated beneficiaries. And if you died 16 years into the policy, it will only be for 4 years, and so on. So the total amount paid out by a family income benefit plan depends on when you die. If you die in the early years of the policy, the total payout will be more than if you die near the end of the policy. So let's now look at a level term policy. As implied earlier in this video, when with level term assurance, unlike decreasing term, the level of cover appropriate to the policy is constant throughout the entire term of the policy period. Accordingly, any sum payable is the same amount regardless of whether death is in the first or last year of the policy. Again, there are many variations on this type of plan, but it really does what it says on the tin and works concurrently with interest-only loans, as the debt is the same at the expiry of the mortgage term as it was at the beginning. So an exact mirror of the protection afforded by level term. So is there any middle ground? When should I use a level term policy to protect a capital and interest repayment loan? The answer, in my humble opinion, is never. Why would you? I've heard many an argument over the years from, my client wants to know that their level of cover is constant, and so when their mortgage decreases, they will have surplus to cover their protection needs. I've heard, they want it so they can use it when they move property and need a bit more. Or they want a bit of extra cover in case they decide to do home improvements at some point. Square pegs and round holes springs to mind. In the first instance, how could you be sure of how much would be available to them as surplus cover? Interest rates, as we've just heard, may have a bearing on how much is left to redeem. How will they know at that point what a bit more looks like? And concerning home improvements, how would they know at any point what they might need for improvements? What if it's not enough? What if they never decide to improve? Another favourite is, surely it's better to buy more cover than they need as it's cheaper to do so because of their age. My thoughts would be, if I had money to burn, why not do it the other way round and overpay the mortgage, and that way they will owe less and may have surplus life cover because of it. The preferred method is to buy exactly what's required at that time and adhere to KISS. Keep it simple, stupid. The regulator will always be interested in cases where the clients have been overinsured without good cause in the event of a claim. And incidentally, there should also be no reason for an automatic increase to a level term policy protecting a mortgage via an RPI feature, as the outstanding mortgage should not be increasing, unless of course it's in arrears. In addition to life cover, these policy types we've discussed can also have added features and benefits. Let's have a closer look. Critical, terminal, or serious illness benefit are variations on the same theme, but are extremely important benefits to have when you've taken a mortgage advance. In my opinion, this is invaluable cover for mortgage purposes, as medical science keeps us all alive a little bit longer than they used to. Bad enough being diagnosed with a condition covered by one of the definitions attaching to these type of policies, but what comfort to know that your mortgage is likely to be redeemed in full, and that if you recover and go back to work, it will be mortgage free. Unfortunately, because of the associated cost with this type of cover, this is something that perhaps is not stressed enough to clients regarding the implications of not being covered. However, that is not your decision to make. Your job is to make sure you outline all of the advantages and disadvantages associated with this kind of protection, so your clients can make an intelligible decision based upon the facts. The quandary for clients generally is, will this ever happen to them? The flip side is, what if it does? How will they cope if they haven't considered it as even being important? How will they continue to work if the event renders them unable to? What income will they have? What's more important is, who will pay the mortgage? You often hear clients say, I can't afford it, especially when they hear the cost. But I would strongly urge you to pose the question, can you afford not to afford it? There will be many implications for them to consider, so best to have the discussion and bottom out all of these concerns. There is many use for this kind of policy coverage, and indeed too many to list during this video. But our intention is to put together workshops with the help of our providers to hone the necessary skills so that you are able to make sure your clients are fully protected and know why. This type of protection is applicable to anyone you will ever meet in theory. This is more about lifestyle than anything else, and it definitely has a place in the mortgage world, but more so when protecting clients in a more comprehensive way. We'll come back to the theory part shortly, but let's take a minute to explore this option in more depth. This policy is all about preservation of income when life is not going your way for whatever reason, be it illness or accident, major or minor. It's designed to pay a monthly income free of tax after a deferred period if you're unable to work, and will continue to do so until such time as you return to work or reach your selected retirement date. Arguably the most valuable policy an individual could have, as it safeguards against all illnesses or accidents, and is payable should they be unable to follow an occupation to which they are suited by way of ability, or, better still, unable to follow their own occupation, the latter obviously being the most desirable definition available via this policy type. If we consider this in the fullness of financial planning, if the mortgage is redeemed by a diagnosis of a condition that's covered by a kick or serious illness plan, then that is beneficial obviously, but your client still has to exist. What's the point of owning a house outright that you can't afford to run because the maintenance and associated utility costs are not manageable? Therefore, having this kind of protection running alongside any other protection product enables your client to at least have some kind of lifestyle. As we are aware, the cost of this type of policy is primarily driven by factors such as occupation, the deferred period before any benefits required, and then by age and health, plus pastimes which may prove too hazardous. Mountaineering is one such pastime that's frowned upon. Earlier, I talked about theory, and so if you can imagine that you are a police officer, firefighter, or a house person, the first two occupations are not generally underwritten, as they're deemed to be too dangerous, and so for them, cover is imperative, as it cannot be bought in this guise. However, a house person can be covered, and although we all accept that perhaps our stay-at-home spouses do not earn a salary, they do have a worth and can be underwritten accordingly. If they were unable to look after the children or run the household, who would? Hired help may be required, but that costs, and so is just another drain on finances. So why not insure against it? The self-employed are particularly susceptible to this kind of issue, and so for them protecting their income should be a must. A couple of things to point out about this kind of cover is, once accepted on risk, only the client can cancel the policy and the insuring office cannot do so, even if they do not like the claims experience. Income can continue until a designated retirement age, and so cover is constant. And rehabilitation benefit is possible, which means that if a rocket scientist claiming benefit goes back to work as a lollipop man, the insuring office will make up the difference in earnings between what he was earning, millions, and what he's now earning, pittance. It is in their interest to do so, otherwise they will bear all of the cost of the rocket scientist benefit until he reaches retirement. I'm sure you will agree that there is a lot for your clients to contemplate, but their decision making will only be as good as your ability to articulate the facts and make sense of it all. Accordingly, things to consider are, how long will your employer pay your client if they are unable to work due to ill health? From Module 2, we know that the answer is not long enough. How will they manage to pay the bills? How will they manage to pay the mortgage? What will they have to give up to pay the mortgage? Will it lead to repossession? If so, where will they live? All absolutely, completely valid questions to ask. Module 4 will be all about putting into practice what we've learned, and so we'll take a look at a few case studies and give the advice for consideration. This will take into account that we should know by now what to look for, what the state and some employers might provide, and what we know to be available. Thank you for listening.